Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Dollar strength is the theme that has continued since Friday as data from the US economy continues to come a little better. On the other hand, China is going through some trouble of its own, with the slide in the stocks not halting despite measures being taken by authorities. Stimulus measures unable to prop up the economy in any significant way. The yuan continues to remain under pressure. Good morning, JK. Another set of data yesterday with the PMIs coming in better. How are you reading it?
Hey, good morning, Swaraj. Yes, the good news from US economy continued, and yesterday's PMI, ISM PMI services was very strong. Not only did the headline number come strong, but also, the details showed that, the inherent strength of the economy, the new orders coming quite strong. And again, the most telling fact was the prices paid that vaulted to 64 from 56.7, and this is the largest monthly gain since 2012. And definitely economy proving resilient. The next headwinds for the bond bulls will be the CPI data next week. The data on PMI definitely already given some jitters, so that even May rate cut probabilities are now down to around 60%, and steadily reducing as well. Added to that, the biggest dough from the Fed, Mr. Goolsbee also said more data needed before starting cuts, and it comes on the back of what Powell also said in his interview on the weekend, that March rate cut is almost out of the contention for the time being. And what we have seen yesterday, is that the traders and investors continue to keep their eye on the bond market now after the big jump that we saw from the Friday's job data. The bond yields have swung a big way, and from Friday, followed by weekend comments from Powell in an interview, and also another Fed member, Kashkari, echoing similar views. So Monday we saw the blues for the treasuries with the two-year crash by 11 basis points, now trading at 4.48, and we had seen as low as 4.11 in the month of January. 10-year also uh, swung up 14 basis points to trade at 4.17. We were as low as 3.90 sometime back, and worse, the closes were all at the highs, and we are not seeing much let up in the yields. A continuous reassessment of the rate cut expectations from the Fed is driving these trades, and obviously the big move in the yields are also influencing the other markets. Equities, we saw the stocks were bullish on Friday, looking at the strength of the economy. On Monday, we saw them sell off, looking at the rising yields and the dwindling prospects of an early rate cut and much lesser quantum that many think now in 2024. All the major indices in US were down. Of course, in the broader picture, stocks do look set for a good correction after gaining 20% from its October 23 lows. Once again, the theme that is taking hold is the rate cut expectations being revised down. But as I said, China is in an extremely different position. The authorities there are quite concerned about the stock market crash that's repeatedly happening despite many support. The national team of China state-backed investors poured about 17 billion into the index tracking funds last month, and they were adding more on Friday and Monday as the markets fell. And so far, whatever we have seen is that these recoveries are short-lived, and the market reverts to the lows. And yesterday also we saw a similar thing happen. Today, market is up 2% from the lows, but we need to really wait and see if that really sustains. See, China is not that it's about the liquidity. It is about the structural issues of the economy that is not getting addressed. While the liquidity and buying support from the institutions may keep the prices from falling further, for a good recovery and a sustainable recovery, we need the Chinese authority to create confidence that the huge debt issues and the real estate sector problems are addressed more effectively. That is what we are waiting to see. In the meantime, next week, we will also see the Chinese go into a long holiday. I think Chinese authorities are really desperate to keep the markets steady and also keep them from falling further during the holiday period due to offshore activities. Now on the dollar, yes, it's also taking the cues from the yields. So we dollar index has gained about 1.5% from the low seen just before the jobs data, and it technically it is showing a good breakout with a bullish reversal, having broken 104.25 decisively with momentum. I expect more gains. And further targets are seen towards 104.75 and 105.80. That is for the dollar index. Accordingly, I expect euro towards 106 and the GBP towards 1.2350, while yen can reach 150. In this short-term dollar recovery scenario, backed by higher yields, even gold can also test 1990. Coming back to rupee, it has weakened to 83.06 yesterday, which is a quick loss of more than 20 paisa from the low seen on Friday. Considering that we are moving in a range of 30 to 35 paisa, it's a significant move. We are already near the resistance at 83.10. That should attract fresh selling from corporate and investors. At the same time, a quick drop of 13 paisa in 1 year forward premium, lower Indian yields and higher US yields will not encourage exporters to sell much. They would rather wait for USD INR to go towards 83.20 or higher before they are tempted to hedge more. Then in overall, the dollar is still looking strong, backed by jump in yields, and that will keep the rupee towards the weaker end of its range for some time. But any large flow can see it quickly retrace higher if the same is not absorbed by the state-run banks. On the whole, we are not moving out of the well-established range for the rupee. Yes, a lot of moving parts in the market. Suddenly today, we also have the Australian Central Bank rate decision at 9 a.m. our time. So unlikely that they are going to change anything on their rates, but their forward guidance, as with all other central banks, will be more keenly watched. Thank you.
Thank you, Jackie. And quickly summarizing, ISM services PMI for the US came in strong. New orders were strong, and because of all of that, May rate cut probabilities are down to 60%, and it's ever reducing. Even the doves of the Federal Reserve continue to maintain a data-dependent approach. And of course, the rising yield has put some pressure on the equities. On the other hand, Chinese equities continue to be under pressure despite the state putting money into the index tracking funds. So, despite all of those measures, even though we see a quick short-term recovery, the Chinese stocks continue to test the lows. And for India, rupee tested 83.06 yesterday, but the lower premiums due to rise in US yields and fall in the Indian yield should keep any exporters away till 83.20 to make the rates attractive. But that's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.